For this learning objective, we'll compute the break-even point for a multi-product company and explain the effects of shifts in the sales mix on the contribution margin and the break-even point. Sales mix is the relative proportion in which a company's products are sold. For each company, different products have different selling prices, cost structures, and thus have different contribution margins. When a company sells more than one product, break-even analysis becomes a little bit more complex, as we'll illustrate with the following example. Lucido Products markets two computer games, the Claim Jumper and the Makeover. A contribution format income statement for a recent month for the two games appears below. Compute the overall contribution margin ratio for the company, and compute the overall break-even point for the company in sales, and the break-even point for the individual products. The first step is to calculate our company's overall or total contribution margin ratio. Our total sales as a percentage of sales, as always, is 100%. That's just our $100,000 divided by $100,000. Our total variable expenses as a percentage of sales is 60%. That's our total variable cost of $60,000 divided by $100,000 in sales, which means our contribution margin ratio is 40%, which we can get by subtracting the 60% expense ratio from the 100%, or by dividing our $40,000 total contribution margin by our $100,000 in total sales. We're going to make use of our contribution margin ratio then to calculate the company's overall break-even point. Recall, break-even is where our net operating income is zero. Since our company's total fixed expenses are $24,000, the company needs to earn a contribution margin in total of $24,000. That's our zero net operating income plus our $24,000 in fixed expense. This means our break-even level of sales for our total company is $60,000 given our current sales mix. We calculate this by taking our $24,000 required contribution margin divided by our current company-wide contribution margin ratio of 40%. We can verify this by completing our contribution margin income statement. Again, sales are $60,000. We've just calculated that. Our variable expenses will be $36,000. That's our 60% variable expense ratio multiplied by our $60,000 in sales. $60,000 in sales then minus our variable expenses equals our required contribution margin of $24,000. This break-even point assumes our current sales mix remains constant. Let's go ahead and look at our current sales mix in order to find out our break-even level of sales for the individual products. Currently, the Claim Jumper makes up 30% of our total sales. We can calculate this by dividing the $30,000 in sales for the Claim Jumper by our $100,000 total sales. The Makeover accounts for 70% of our current sales. Thus, at our break-even point, we assume the same sales mix, so the Claim Jumper sales will total $18,000. This is our $60,000 break-even level of sales company-wide, multiplied by the 30% sales mix dedicated to the Claim Jumper. Makeover sales will be $42,000. That's again the $60,000 break-even level of sales multiplied by the 70% sales mix that's attributed to the Makeover game. So we see calculating our break-even point or target profit for a company with multi-products is a simple extension of our single product break-even analysis. A few assumptions we need to keep in mind though. When we perform cost volume profit analysis, we assume a constant selling price, that our costs are linear, that is, they can be divided evenly between a fixed component and variable components per unit, and that if we're dealing with a multi-product company, the sales mix remains constant. That is, going back to our Claim Jumper and Makeover computer games for the Lucido product, our sales mix remains at 30% Claim Jumper and 70% for the Makeover. Since our contribution margin ratio for the makeover is higher than that of the claim jumper. If we were to shift our sales mix towards the makeover software, then our break-even point would be lower than $60,000. If, on the other hand, we started selling a greater proportion of claim jumper software, whose contribution margin ratio is lower than 40%, we would need to sell more games to achieve our break-even point. Finally, in our cost volume profit analysis, we're assuming that for a manufacturing company, the level of our inventories don't change. In other words, the units produced equals the units sold.